What's up, financial rebels and aspiring oligarchs? It's your favorite slightly cynical, always caffeinated Gen Z financial analyst, back again to spill some serious tea. Today, we're not talking about your latte budget or whether avocado toast is financially sound. It's not, sorry. We're talking about the real secret sauce, the forbidden knowledge, the riz behind how the top 1% don't just get rich, but stay rich, and then make their kids rich, and their grandkids richer, all thanks to something most of us are taught to fear: debt. Yeah, you heard me. Debt. But not the maxing out your credit card on fast fashion kind of debt. We're talking about the sophisticated, leverage-heavy, tax-advantageous kind of debt that basically acts as a superpower for those already swimming in cash. It's time to pull back the curtain on how the financial elite use debt and a maze of tax loopholes to build generational wealth, legally, ethically, mostly, and absolutely ruthlessly. Buckle up, buttercups, because this is going to be an 11-minute masterclass in how the game is actually played. Let's get into it. The good debt versus bad debt myth, rewritten by the rich. Alright, so for us mere mortals, debt is usually painted as the villain. Credit card debt. Bad. Student loans. A necessary evil that crushes your soul for decades. A mortgage? Okay, maybe a little good, but mostly a huge, scary commitment. But for the 1%, that entire narrative gets flipped on its head. They don't just tolerate debt, they weaponize it. They understand that debt isn't just about borrowing money, it's about leveraging other people's money, or OPM, to amplify their returns and minimize their tax burden. Think about it. When you buy a depreciating asset with debt, like a fancy car that loses value the second you drive it off the lot, that's bad debt. It costs you money, it loses value, and you get no financial benefit. But when the wealthy use debt to acquire appreciating assets or assets that generate income, that's their definition of good debt. It's not about consumption, it's about acquisition and growth. They're not borrowing to buy liabilities, they're borrowing to buy assets that then cover the debt payments and ideally, grow in value. And guess what? The interest on that kind of debt is often tax deductible. Mind blown yet? We're just getting started. Real estate and the depreciation magic show. Okay, let's talk real estate, because this is where the debt and tax loophole synergy really starts to cook. The rich don't just buy a primary residence and call it a day. They invest in income-generating properties, apartment complexes, commercial buildings, industrial warehouses. And they don't pay cash, they use massive mortgages. Why? Because leveraging a 20% down payment on a $10 million building to control $10 million in assets means they get the appreciation on the entire $10 million, not just their $2 million equity. That's a 5x leverage multiplier, for real. But here's the kicker, the actual magic trick: depreciation. Even if their properties are appreciating in market value, the IRS allows them to deduct a portion of the building's value as an expense each year, because buildings wear out. This is a non-cash expense, meaning no money actually leaves their pocket, but it reduces their taxable income. So, they're making money from rent, the property value is going up, and they're paying less in taxes because of a theoretical loss on their books. It's having your cake and eating it too, but with a private jet and offshore accounts. And it gets even spicier. They employ cost segregation studies where specialists break down the property into its components, fixtures, landscaping, etc., that can be depreciated much faster than the building itself. This accelerates those non-cash deductions, creating even larger tax write-offs in the early years. Plus, when they want to sell, they don't necessarily pay capital gains tax right away. Enter the 1031 exchange. They can sell one investment property and roll the proceeds into another like-kind investment property, deferring those capital gains taxes indefinitely. It's basically a never-ending tax-free property swap, building an empire on deferred taxes. It's a slay, but also, low-key kinda unfair. Business debt and the art of deductible everything. Moving on from bricks and mortar to boardrooms and balance sheets. The wealthy don't just own real estate, they own businesses, often many of them. And guess what powers these businesses? Debt. Big, beautiful, tax-deductible business debt. Whether it's a loan for expansion, R&D, acquiring another company, or just managing working capital, the interest paid on that business debt is a legitimate business expense that reduces the company's taxable profit. But it's not just interest. Think about all the perks that come with running a successful business. Lavish client dinners. Business expense. That private jet flight to meet with investors. Business expense. A fancy office in a prime location. Business expense. High-powered legal and accounting teams. Business expense. For the average person, these are luxury items. For the wealthy business owner, they are necessary costs of doing business that legally reduce their taxable income. It's all about framing, and having good accountants, who, surprise, are also a business expense. Furthermore, many wealthy individuals structure their businesses as pass-through entities like S-corporations or LLCs. This means the profits aren't taxed at the corporate level, but pass through to the owner's personal income tax returns. But here's the trick: the owners can often take a reasonable salary, which is subject to payroll taxes, but then take the remaining profits as distributions, which are not subject to those same payroll taxes. It's a way to pay themselves more efficiently, tax-wise. It's not outright dodging taxes, it's just optimizing the hell out of the tax code that was arguably designed with these exact types of structures in mind. IKIC. Private equity and leveraged buyouts, buying companies with their own money. Now, for the really spicy stuff, private equity and leveraged buyouts, LBOs. This is where the ultra-rich, often through investment funds, acquire entire companies. And here's the shocking part: they often buy these companies using a ton of debt, and a significant portion of that debt is then loaded onto the balance sheet of the acquired company itself. Yeah, you heard me. They use the target company's assets and future cash flows as collateral for the loan they take out to buy it. It's like buying a house and making the house pay for its own mortgage. Wild, right? The private equity firm puts in a relatively small amount of their own capital, equity, and uses a huge amount of borrowed money, debt, to complete the acquisition. This amplifies their potential returns exponentially. If the company grows, the private equity firm makes a killing when they eventually sell it, having leveraged someone else's money to do so. And guess what? The interest payments on all that debt the acquired company took on are, you guessed it, tax-deductible for the company, further reducing its taxable income. It's a perfectly legal, profoundly effective strategy that generates massive wealth for the private equity partners and their wealthy investors. Beyond the LBOs, these partners also get paid through management fees and carried interest. Carried interest, which is a share of the profits from the investments, is often taxed at the lower long-term capital gains rates, rather than ordinary income rates. It's a loophole that has been debated for years, but for now, it's a significant tax advantage for those in the private equity world. It's giving multimillionaires getting tax breaks designed for long-term investors, and honestly, it kinda slaps if you're on the right side of it. Estate planning and the generational wealth transfer cheat code. So, the rich have used debt and deductions to accumulate vast fortunes. Now, how do they ensure it all passes seamlessly, and with minimal tax, to their offspring? This is where sophisticated estate planning and a whole lot of trusts come into play. We're talking about building dynasties, not just bank accounts. One popular strategy is the Grantor Retained Annuity Trust, or GRAT. Imagine you own a business or a portfolio of stocks that you expect to skyrocket in value. You put those assets into a GRAT for a specific term, e.g., 5 years. For that term, the GRAT pays you an annuity. If the assets grow beyond the IRS-mandated interest rate, known as the 75/20 rate, that excess growth passes to your heirs essentially gift tax-free. It's a way to transfer future appreciation out of your estate without incurring huge gift or estate taxes, especially if your assets perform well. It's basically a bet that your assets will grow more than the government expects them to. Then there are irrevocable trusts. These are powerful tools for asset protection and tax minimization. Once assets are in an irrevocable trust, they are no longer legally considered part of the grantor's estate. This protects them from creditors and can significantly reduce estate taxes upon death. The rich use these to hold everything from real estate to business interests, ensuring a smooth, tax-efficient transfer of wealth across generations. They can set up specific rules for how the money is distributed, ensuring their lazy kids don't blow it all on NFTs. And finally, the stepped-up basis rule. This is a massive one. When a person dies, their appreciated assets, stocks, real estate, etc., get a step-up in basis to their fair market value on the date of death. This means that when the heirs sell these assets, they only pay capital gains tax on any appreciation after the original owner's death, not on the total appreciation from when the asset was first acquired. This effectively wipes out decades of accumulated capital gains taxes. It's a huge loophole for transferring wealth tax-free through generations, and it's a primary reason why inherited wealth often stays intact. It's a real, get-out-of-jail-free card for capital gains. Why it works for them, and why it's hard for you. So, you've seen the playbook. Now you're probably thinking, why can't I do all this? Good question. And honestly, it boils down to a few critical factors. First, access to capital. The wealthy have collateral, established relationships with banks, and a track record that allows them to borrow massive sums at incredibly low interest rates. Most of us are not getting a multi-million-dollar mortgage for an apartment complex at 3% interest without a significant down payment and a lot of hoops. Second, sophisticated advice. The 1% have entire teams of CPAs, tax attorneys, estate planners, and financial advisors working tirelessly to find and exploit every legal loophole. This kind of expertise is expensive, costing hundreds of thousands, if not millions, of dollars annually. For them, it's an investment that pays for itself many times over in tax savings. Third, scale. These strategies are most effective when applied to large sums of money and significant assets. Depreciating a $5 million building is a lot more impactful than depreciating a $300,000 duplex. The tax savings scale with the size of the investment. And finally, risk tolerance. While these strategies are designed to be safe, there's always a degree of risk with leverage. The wealthy can often absorb losses that would financially devastate the average person. They can play the long game because they have the capital to weather market downturns. Can you adapt some of these? Absolutely. Understanding good debt versus bad debt is a start. Investing in income-producing real estate, even a single duplex, can utilize some depreciation benefits. Setting up an LLC for a side hustle can open up business deductions. But let's be real, you're probably not setting up a GRAT unless you're sitting on a few million in appreciated assets. It's a scaled game. Conclusion, the game is rigged, but you can learn the rules. Alright, folks, we've just spent 11 minutes diving deep into the intricate, often frustrating, but undeniably brilliant ways the top 1% use debt and tax loopholes to build and protect their generational wealth. It's not about being smarter, it's about playing by a different set of rules, rules that are perfectly legal and written by lobbyists, for lobbyists, and for those who can afford the best legal and financial minds. So, what's the takeaway? Don't be mad, be informed. Understand that the financial landscape is not flat. It's got hills, valleys, and secret tunnels for those with the right map. My hope is that by exposing these strategies, you feel less like a tiny pawn and more like someone who now understands the full chessboard. You might not be able to play the exact same game, but you can certainly learn from their tactics and apply scaled-down versions to your own financial journey. Start small, think big, and always question the narratives you're given. Knowledge is power, and knowing how the other half lives, and more importantly, how they invest, is a serious power-up. Peace out, financial rebels. Keep learning, keep earning, and don't let the system grind you down.